Hi, and welcome to Forex Academy Lesson 7, CCI. The Commodity Channel Index uses a more complex way to filter out the most radical price action. It aims to keep the relevant information as much as possible, while still functioning as a filter. To achieve this, it uses more than just the closing prices, like most other moving average methods. It uses something called the typical price, which is made up of both the high, the low, and the closing price over a specific period. This makes the CCI more representative of the whole spectrum of prices in any given period. It then goes on to apply some sophisticated mathematical tricks to these prices, which I won't bother you with. There are plenty of people who would gladly explain all the intricacies, but not me. I'm just too lazy. Anyway, I assume that you're watching this video mainly because you're lazy too. So let's dispense with the mathematics and come right to the point. How are we going to use this baby? The CCI being another momentum meter, like RSI and the stochastics, you can obviously use it to fade the trend, like we've been doing in the past two videos. But this time I'd like to discuss another Forex trading feature. We're going to look at divergence. Simply put, divergence is when the actual price is still making higher highs or lower lows, but the indicator, in this case the CCI, is making lower highs or higher lows. Well, this tells us that a trend is exhausting, consolidating, or even reversing. First, let's take a look at the actual indicator on the chart. Once again, the CCI has its own special little box, but the scales are somewhat different. The line ranges between way above the value of 100 and way below the value of minus 100. The neutral zone is between 100 and minus 100, and beyond these values prices are looking overbought and oversold. Once again, it might be handy to manually insert your own lines here. That's rather easily done, as you can see, and now we're all set to find an example of divergence. Now, here we have an example of prices making higher highs, while the CCI seems to be winding down toward the 100 level. By the way, this particular method applies only in overbought or oversold territory, so don't use this in the neutral zone. Do you see how the lines diverge? Let's scroll to the right a little bit and see what happens to the price. Oh, you see? You see? I told you it would reverse. Of course, I already knew that it would. And there are also many examples of divergence plays not working. I'm just showing this as an illustration of another way to use these momentum meters. Once again, don't fly by the seat of your pants here. There are always people who maintain that they never even look at the actual price graph and trade only on the indicator, be it RSI, CCI, or yet another method. What we would like you to do is know what these indicators are for, be able to use them and look to them for one of two things: an early warning sign that something is about to happen, or corroboration that strengthens the evidence that something is indeed happening right now, and now might be the right time to enter the market. I know I've said it before, but don't trade blindly upon technical indicators. No matter how many of them you use, technical analysis is just one part of Forex trading. Never overlook the paramount importance of the economic news, for instance. We'll be tackling the different economic calendar items soon, but let's first, in the next lesson, take a look at Fibonacci. If you want to learn more about the CCI, please feel free to visit the article section on forexacademy101.com.